Can you hear me now?
Yes, we can hear you.
Okay, good. Okay, thank you. Okay, so let's start. So this is, I think, where I stopped yesterday, and I had requested you all to kind of look at the next two or three slides, next 4 or 5. Okay, guys. So I had asked you all to look at this 4 or 5 slides. Did you all look at it, guys? Did you all look at the slides? This bull spreads using puts, bears and the bear spreads using calls and puts.
Yes, we can see the slide, Professor.
Again of the Okay, any questions? Guys, any questions? Do you have any questions on those 4 or 5 slides that you have looked at, bull spreads and bear spreads? Guys, please tell me if you have any questions. Do you have any questions? Okay, then I can move on. So that's what I'm really requesting you to tell me. Then I can kind of move on to this slide on butterfly spreads. Now, what happens is, this is an example that we kind of did earlier. So before I do the butterfly spread, so what happens in the bull spreads, like the one that I showed you yesterday, and the butterflies and the other ones, the bull spreads and the bear spread, is that what it means is that in a certain zone, and for it to kind of for you to make money and for you to kind of get the benefit out of that. So your expectation is always that the price will be in that area, and that is what you are kind of trying to look at in terms of ensuring that that your costs are reduced because of the structuring that you because of the structure that you take. Your costs are reduced, because remember, you're buying one option, selling one option. So though you're paying a premium for buying an option, you're earning a premium for selling the option, and therefore to that extent the cost reduces, and that's what you are kind of that's where the benefit that you can get out of that. Now, in the context of butterfly, what we are doing is in the butterfly spread is that, as you can read out there, I have 3 options. And this is the example that we for simplicity, I'm assuming K1 to be the one with the low strike price, K2 is the one with the middle strike price, K3 is the one with the high strike price. And typically, K2 is the midpoint of K1 and K3. We assume that K2 is kind of close to the current stock price, though it does not have to be close to the current stock price, but we kind of assume that K2 is close to the current stock price. Right? Hello? Hello? What's happening? Hello? Hello? I lost it again.
Professor Basu, can you hear me? No.
Okay, I don't know what's happening today. Again, there's the same problem like the first day. I seem to be losing connectivity, but I'll try to go ahead in the same manner that we were doing. So this is what it is. Now what happens is, out here, the moment you buy the stock with a low strike price, your premium, it's a call option, your strike price is high. Your premium is high. When it's a high strike price, your premium is low, and this is somewhere in between. Now, what is the net premium? Remember, this is, let's say, C1. This is let's assume that this is C1, this is C3, and this is C3, and this is C2. So if you're buying the ones you're paying, right, and you're selling your earnings, so basically I will have 2 C2 minus C1 minus C3 as the premium. Now I'm going to make an assumption, and the assumption that I make is this, that 2 C2 minus C1 minus C3, which is twice the 2 sold options minus the bought option with the strike price of K1, minus the bought option with the strike price of K3. This I'm going to assume is negative. I mean, why is it negative? How do I justify it is negative? I will come back to that in a minute. But at this point, I'm going to assume that it is negative. And what is the advantage? And then what happens is you look at the dotted lines. I have bought two options, one at K1, one with strike price and one at strike price K3. So the two dotted lines at the bottom. And then I have sold two options in the top, which is two options with strike price K2. And therefore, you can see that, the price kind of drops. You lose the money at K2. My assumption is that the price, the net premium, which is 2C2 minus C1 minus C1 minus C3 is negative. Let us assume that it is negative and work from there. And then what you get is the red line. Because what happens below K1, none of the options get exercised. Between K1 and K2, only one option, bought option gets exercised. So you start making money. At K2, both the sold options get exercised, which means you lose money because one bought option you square off. You bought at K1, you're selling at K2, so you're making a profit of K2 minus K1. But the other one you're selling at K2 when the price is more than K2, and therefore you start losing money till you get to K3, at which point you can buy the next option at next asset at option. You can exercise the option and buy it at K3. But what happens is and therefore you limit your loss because you're buying at K3, selling at K2, K3 being larger than K2, so your loss is K3 minus K2. But on the other hand, you made a profit of K2 minus K1. And given that K2 minus K1 is equal to K3 minus K2, so your profit becomes 0. And again, therefore, so it's a premium that you stand to lose. And that is how the graph kind of becomes, the red line kind of shows up in the way it does. Now, what is the market view? So two things. When would you do this? What is the view of this? And the second thing is, why did I assume it to be negative? Okay, when do you do it? You will do it if you believe that the asset price is going to remain range bound in this zone, because that is where you're making a profit. So your expectation has to be that the asset price will be somewhere here, will not go on either side, will not go far out. Your expectation is that asset price will remain range bound, and that is where you will kind of use this, because that is where you will make money out of it. On the other hand, if it goes on the two extremes, you will lose money, and therefore it doesn't make sense for you to kind of do this structure if that happens. So this is a mechanism for you to protect yourself. If you believe that the asset price is going to remain in the center, you can make some money out of it, and your net premium is still low because it is a combination of the three premiums. Now, why am I assuming it to be negative? Okay, let's look at it this way. So if my assumption of net premium being negative is wrong, what can it be? I've assumed it to be negative. If my assumption of net premium negative is actually wrong, so I got it wrong, what can it be then? If I made a wrong assumption, what can the other choices be? Remember, I've assumed the net premium to be negative here. Now, if this assumption was wrong, what can the correct assumptions be? What are the other choices that I have? So, if my net premium is negative, is my assumption, what are the other choices that I have? If my assumption is wrong, what can it be? What can the net premium be? What can the net premium be in that case? If my net premium is negative, is wrong, please, what can it be? I made an assumption, and if the assumption is wrong, what can the net premium be? Huh, guys? So realize the red line out here. I mean, I cannot automatically say this, but that's what I'm trying to show you. If this red line, I've made this assumption is negative, if this was wrong, if this is there, then this is how the graph will look like. That's fine. Now, my question to you is, if this was wrong, if I had made a mistake, what are alternate values? If this value was wrong, what are the alternative values that it can take? My net premium is negative is wrong. What are the alternative values that it can take? Somebody. My net premium is negative is wrong. What is the alternative value that it can take? What else can it be? If it cannot be negative, what else can it be? What else can it be? If the value is not negative, then what else can it be? Guys, what else can it be if it is not negative? You see somebody typing. So tell me, if it is not negative, what else can it be? Exactly, zero or positive. Please answer, guys, because otherwise it's very difficult to continue teaching in this manner because I wouldn't know what you all are following. And it'll just be a monologue from my end. I have no response. As it is, you guys are not responding much. And then even if I ask you if you don't respond, it becomes very difficult to understand what is going on. Right. But let's come back here. You're right. It can be either zero or positive, which means that this red line would simply get shifted up towards the x-axis or above the x-axis. And then if it is positive, what would happen? The holder would make a small profit at certain zone and then a large profit in the middle and again back to a small profit. But what happens is that the holder will make a profit under all circumstances. Now, if the holder makes this profit under all circumstances, the counterparty, the writer, will therefore lose money under all circumstances. Because of the deal between you and me, if I make money under all scenarios, you will therefore lose money under all scenarios. And if you lose money under all scenarios, do you have any incentive to enter into such a product? Obviously not. You don't have any incentive to enter into such a product. And hence, that makes no sense. If it is equal to zero, the other case is if it's equal to zero, so this line kind of goes up and becomes along the x-axis. And then in the middle, it is up. What would happen? That would imply that the holder is not making any losses. However, in the small part, it is making a profit. So if that is what the holder is getting, the counterparty, the writer, is therefore not making any losses when the holder is not making any profits. And when the holder makes a profit, the counterparty, the writer, loses. So then again also you have the scenario that under no scenario will the writer make any profits. And if the writer does not make any profits, what is the incentive of the writer to kind of continue with such a deal? And hence it will not really work. So thus, my assumption that this net premium in this case is negative holds, right? And this is where the payoff actually happens. Now, one quick thing. So I took an option. I took the butterfly with this framework where I bought where I was buying at the two ends and selling in the center. I could also have it the other way around, where I was selling at the two ends and buying at the center. In which case, the net premium will be, I'm buying at the two ends, C1 plus C3 minus 2C2. And by the same logic, I will assume that C1, the net premium in the other case, in the alternate case, will actually be positive. And the graph will simply be a mirror image. If you take the red line and reflect it around the x-axis, that is what your graph, what it will look like. So it will be like this. So it will be a V with the two sides extended. And that is how it is called as a butterfly, because that is how it looks like a butterfly also. Now, in this case, the story is that I will only want it in this zone. I do not want spot to be on this side, and I want to make money because of that possibility. In the opposite scenario, so this is a long butterfly. If I go to the other one, which is a short butterfly, which is where I sell at the two extremes and buy only in the center, if that were to happen, then essentially I'm assuming that the price will not remain range bound. The price will not remain between the two observations, because I don't want it to, because that is where I'm making losses. I would want it to be on either greater than or less than on the higher side or on the lower side. So that is where I make some money out of it. So therefore, in that scenario, I would expect it to be I'll expect the premium to be negative, to be positive, and then look at it accordingly. Okay. What is this? This is actually the payoff from the structure that I kind of showed you out there. And given the last line that I have comes from the fact, or will arise out of the fact that the payoff from the K2 is actually the midpoint. So I'm assuming K2 to be the midpoint of K1 and K3. That is what will result in the last point. If it is not the midpoint, what will happen is that I will have the graph, which is what you looked at, but the graph will not look so easy or so symmetric, and the relationship will be kind of a little skewed. It may not actually exactly symmetrically branch out. It may actually be a little skewed on the others on the sides. Right? So that's something that you can kind of get if it is not equal to not at the midpoint. Now you can also do a butterfly spread with using put options, and then what that means is that you will kind of do it with whatever you did with the call, you will do with the put, and you will basically therefore buy two puts, with the one with a low strike price, one with a high strike price, and sell two puts in the intermediate strike price. Or that is one structure. Or the other structure is you sell a put with the low strike price, you sell a put with a high strike price, and you buy two puts in the middle with an intermediate strike price. Because whatever you can do with the call, you can kind of do with the put also. So there is nothing stopping you from doing whatever you did with the call when you doing with the put, right? And the pay, and you can similarly you can look at it, and you will find that the payoff diagrams are also kind of coming up in this manner. Now, what happens is that you see, one of the things that we did, and the way we did this was, we said that only two things that you can change around is X and T, strike price and time to maturity. So when we took the strike price, and we in all the spreads up to now, we played around with the strike price, and we kind of kept it as we kind of so as I said, we kept the time to mature, the other terms including time to maturity constant. We just changed the strike prices, and therefore we got the different structures, and then that led to the scenario that so that kind of got me what was called as horizontal spreads, or price spreads. The alternate way of looking at this spread strategy is to kind of say, okay, instead of looking at horizontal spread, which is instead of playing around with strike prices, we will keep one strike price. We will keep the strike price constant. However, we will let the time change. So one option will have time T1, the other option will have time T2, where T2 is greater than T1. Obviously, I can buy, I can sell, I can do all of it, but essentially one option will be with strike price T1, the other option will be with the strike price T2. Now, both options are, therefore, as you can see, both options have the same price, but different expiration dates. And therefore, and this kind of a thing where you're playing around with the calendar, with the dates, is what is called as the calendar spread. So a calendar spread typically is created by this structure, which is basically, selling a call option with a certain strike price and buying a longer maturity call option with the same strike price. Or you can do the other way around, which is buying a call with a certain strike price and selling a longer maturity call with the same strike price. So you realize your strike prices are the same. It is only that the time to maturity is different. Now we also know that longer is the time to maturity, the more expensive the option is. And therefore, in a sense, since you are buying a longer, in this example, since you are buying a longer maturity call, you would need to, the premium would be higher than a shorter maturity call, which means you'll actually have to pay for the premium. If you did the other way around, you would not have to, because you were buying the shorter maturity call and selling the longer maturity call. Now, this kind of a spread is not very popularly used in the market. Unlike the other ones, this is not very popularly used in the market. And the reason for that is this. Because the times are different on the two options, the exercise, the point at which you're going to exercise, remember these are all European options, the point at which you're going to exercise are different. Let's say there is a 1 month gap, therefore you're exercising one today, you're exercising the other after a month. Or you're considering exercising the other after a month. And therefore what could happen is the decision of the structure today and the decision of the structure after a month may not be the same. So realize that if it is on the same day, only the call or the put can be exercised. Both cannot be exercised simultaneously. However, if you take different time points, then both can be exercised. Both the call and both the calls. Well, this is one with a higher strike price and another with a lower strike price. Or similarly with puts, all of them can be exercised. And the idea in general is that both of them will not be exercised. So that's how we kind of we get that. And then we get a replication of the American option framework closely. Now, because of that uncertainty, we really don't want to get into this kind of a structure, and therefore the market is not very keen to look at this kind of a structure. The market typically looks at the basic spread structures, which is bull spread, bear spread, and the butterfly spread per se. It very rarely looks at the calendar spreads. And as you saw in each case, you have a certain market view, and you can kind of protect your market view or even so therefore that kind of a thing can happen, and we really rarely look into that. So we don't per se bother about the calendar spreads. Though you can kind of calculate the calendar spreads, we do not. The other spreads become relevant as I said, we will have these prices, we will have these values, and then we are kind of netting it off. And so we are reflecting our position and our view, but we are, because of these spread strategies, because we are buying and selling at the same time, we can effectively reduce the cost that we are paying. Right? And therefore, what you can see is that when you draw these graphs, the graphs on either side is not straight line. Because of this time change, you have this. So you have the dotted lines, and you have this, somewhat of a curve coming in, which is very difficult to explain. And also, as I said, it becomes like an American option because both can be exercised the same. I mean, both the decisions can be interchanged at different points in time, and therefore, the exercise is not very clear. So that is what we can kind of avoid using this argument. Now, a lot of the stuff that we did in the context of spreads, particularly the butterfly spread, can be replicated by doing what is called as a combination. So following on from yesterday, a combination strategy is a strategy where you are going to combine a call and a put. It is not a call, it is not only calls or it is not only puts. It is a strategy where you are combining a call and a put. So what is happening? I'm going to buy a call and a put, or I can sell a call and a put. Now, obviously, the two options in general will be at the same strike price, but under different compulsions, there could be at different strike prices also. So the call and the put strike price does not need to be the same. Now, broadly, there are 4 structures that you can get, and then we'll highlight as to where you use each one of them. The first one is a straddle. What is a straddle? A straddle is buying a call and a put together at the same strike price. Therefore, you actually paid double, not double, because I don't know which one you're taking. And remember, as we saw yesterday also from the put call parity equation, the put and the call values are not the same. So what will happen is, therefore, you cannot say it's double the put value, double the call value. So to that extent, we will get the net premium will be the sum of both the premiums, not just any one of them. Now, I'll talk to each one of them as you go along. So you have what is called as a bottom straddle, which is and when do you do this? So this is a risk management technique that you are kind of doing. When are you exercising this? You are where you expect the market to move. You're expecting a large move in the market, but you do not know which way the market will move. So we know that some event will happen in the next whatever period. We do not know, but what we do not know is which way this market will impact the market. Right? So I'm expecting the market to move. I'm sure that the market will move up or down, but I do not know which way the market will move. Some action could cause the market to really zoom up or crash. So I am playing, I'm uncertain about the direction of move, and I'm protecting myself against the direction of move. So I can then buy a bottom straddle or a long straddle, which basically involves buying a call and the put at the same strike price and expiration date. If I take the reverse, I get what is called as a top straddle or a short straddle, where I am selling both at the same time, with the same strike price and expiration date. And what happens in the first case, in the bottom straddle or the long straddle, the graph looks like this. I'm buying both the options at the same strike price, right? So therefore, the two dotted lines, as you can see, with the same strike price. The resultant value is the red V. And this is where I've bought both the options, and that is a long straddle or a bottom straddle. And the resultant option is the V that you see, which means what? If the asset price goes below the strike price, I will use the call option, the put option. Okay? And you can see the table below, the payoffs. Now, the problem of this option is that the price of this option is actually very high, because now you are not paying, you are paying the price of two options. You bought both the options. Unlike in the case of the straddles, where you were buying some and selling some, and therefore you are getting a netting of benefit. Here you are not getting any netting of benefit. You are buying all of them, and therefore the net premium that you pay is quite high. And that is the problem of the bottom straddle. If you look at this, this is very similar. So, okay, what is the market view out here? There are two market views that get combined out here, and that is what you're protecting yourself against. And that is A, the price will not remain around K. So for a long straddle or a bottom straddle, and if you're buying the bottom straddle, your market view is that price will not remain. And the price will kind of so basically, price will not remain range bound. Price will either move up or move down. And the second thing that happens is, the second position point I'm taking is, I do not know which way the price will move. The price can go up or the price can come down. And I'm trying to take protection on both of it, when it goes up or when it kind of comes down. Now, you also have something called a strip and a strap. So if the straddle consists of just one call and one put, the strip consists of a long position in one call and two puts. And similarly, the strap consists of a long position in two calls and one put. So what am I doing? I'm basically saying that if the in the event that the option is in the money, that the straddle is in the money, why should the rate of movement on the upside and on the downside be the same? So why should the rate of movement from A to B be the same. Right? Why should it be at the same rate? And why should the rate at which it moves should be the same? In fact, in practice, we know that in practice, we know the fact that the rate at which prices crash or prices come down is faster than the rate at which prices increase. So we know that the price increase is typically going to be slower than the price decrease. Now, if that is the case, why should I take the ratio to be of the options to be exactly 1:1? And that is what we are addressing out here in the strip. As I said, I'm taking two long positions, I'm taking a long position in the call and two puts. I'm buying one call and two puts. So obviously, if the price goes down, I have a sharper prediction, and my expectation is the prices will not really go up in an abnormal manner, and therefore I have a protection in the call. Well, this is true in most cases. You could also have the reverse story coming in that it consists of a long position in two calls and one put long position, and you are buying more calls than puts because you are expecting the price to move up faster than it is moving down. Now, in both cases, the investor is betting that there will be a big stock price move and considers that the movement on one side is more than the other, depending on which one he takes. The graph would look like this. The graph of the corresponding scenario would look like this. In the first case, remember in the strip, you have two puts and one call, therefore the put side becomes sharper. In the case of a strap, you have two calls and one put, and therefore the call side becomes sharper. In all these scenarios, you have a basic underlying position, you have a basic underlying assumption, and the basic underlying assumption is that I do not know which way the price will move. All I know is the price will not remain range bound, but I do not know which way will it go up or will it go down, which way the price will move. And that is what I am protecting myself against this. In the simplest case, I simply bought both the options. Yeah. Right? In the context of the strap, again the same thing. I do not know which way the asset price will move. But if the asset price moves, I now believe that the asset price is going to move up much faster than it will move down. And therefore, I protect myself by buying two call options as opposed to one put option. Now, should just buying two call and one put or two puts and one call, is that good enough? Well, in theory, the answer is no. You could have a scenario where you have, if you can, So again, my basic position that I do not know which way the asset price is going to go is there. The only additional thing that I am saying is that, but I know that if it goes up, it will go at a certain rate, which in the second case is faster than if it goes down. And that is what I model, and therefore I can kind of account for that. Right? Now, one of the things that you also see in a straddle or in a strangle is that I can replicate the same thing that I was doing in the butterfly, except for the fact that the cost will be much higher and the expected return will also therefore be significantly high. So I actually have a high cost, but I also have a significantly high potential return. And that is what we are kind of using this out here to talk about. Right? Now the other one, the last one that I had out there is what is called as a strangle. Now the strangle is nothing but a straddle. Right? So now I'm basically saying I'm the same thing as a straddle. I'm buying both a call and a put. So if it's a long strangle, I'm buying a call and a put. If it's a short strangle, I'm selling a call and a put. The only difference is that I am not doing it at the same strike price. I'm taking two strike prices. The strike price for the call option is higher than the strike price for the put option. In general, if you're talking about the single strike price model, that is somewhere in between, right? And therefore, the call strike price is higher than the put strike price. What does it mean? Again, it means, or when do you do it? Again, it means, or you do the same thing. If the price, so this is the graph, and you have the dotted lines. If the price is above the red line on the right hand side, you will exercise the call option because you don't know which way it will move, but exercising the call option gives you a higher profit. Similarly, if it is below than K1, you will exercise the put option because that will kind of give you additional profits. So depending on which one comes in, you will kind of give it a call option. You will use it as a call option or effectively as a put option. Okay. Now, therefore, what happens is the price. Yes, Farid, you had a question. Farid, you had a question. Farid, I thought you were trying to ask something, Farid. Do you have a question? Can you go ahead? Go ahead with your question. Do you have a question, Farid? Hi. Okay. No, not you. Farid was trying to say something, so I just thought he had a question. Okay, Farid, if you have a question, please tell me. Otherwise, I will continue. Okay. Now the point is that in this case, what will happen? In this case, the thing that will happen is that okay, I'm still there, right? Yeah. In this case, what will happen is that where did the chat go? Okay, the chat is here. In this case, there is a part between K1 and K2. If your spot price is between K1 and K2, you will not get any benefit. You will get a benefit only if the price is above K2 or if the price is below K1. Between K1 and K2, you will not get a benefit. And therefore, that is the part where you will lose your premium. But the only thing out here is you will not lose one premium. You will lose the sum of the two premiums. And therefore, your potential loss can actually be very high. In fact, these options are going to be way more expensive than regular options. Between the straddle and the strangle, the straddle is more expensive because it is only at one point. So if you're above that point or below that point, you always have a call or a put option which will be applicable. Here there is a range between K1 and K2 where none of the two options will be exercisable, because even if you do, it is actually in the zone where it does not really make a difference. You are not exercising it, and hence, therefore, this becomes the strangle. Therefore, becomes so therefore, what you are going to see is that the straddle and the strangle both are expensive, but between the two, the straddle is slightly more expensive than the strangle. Now, when do you do it? And then what is the idea? The idea is to protect yourself in the scenario that I do not know which way the asset price will go. But if I go with a long straddle or a long strangle, I'm basically certain that the asset price will move. That I am certain that there will be a large move in the asset price, but I do not know which way the asset price will move. And that is what is kind of, protected by going in with by kind of doing this kind of a structure. On the other hand, if I am absolutely certain that the asset price will not move, it will remain range bound, then instead of going long straddle or long strangle, I should go short straddle or short strangle, which basically means I should then sell the call option and the put option exactly at the same strike price, earn the principal, earn the if I'm absolutely certain that it will not move, I will actually take the reverse position, which means I will sell both the call and the put. I will earn the premium. So as long as the two options are not exercised, I am making a profit, which means this line will just get get reflected on the x-axis. So your profit will be capped, but your losses will actually could potentially be infinite. But that is the context when you are kind of going on a short straddle or on a short straddle. As long as you are on a long straddle or a long straddle story, you are basically saying that the asset price will move. I am not certain which way the asset price will move, and right? So that is where the utility of this comes in. So in all of this, again, remember, we are doing this because we want to take a position. What we do is therefore we want to protect ourselves. So I'm not sure. I'm sure that the asset price will move, but I'm not sure which way the asset price will move. And that is what I am trying to protect myself using this approach, as you can see. Okay. Let's look at some examples before we move on to the next bit, which is the pricing bar. So you have a call option that costs you $2, a put option with a strike price of 50, a put option with a strike price of 45 costs you $3. So what happens when you create a strangle? What is your total premium? When you create a strangle on this, what is the total premium that you pay? So in this, when you are buying both of them, what is the total premium that you are paying? What is your total premium? What is the total premium that you are paying? Guys, what is the total premium that you are paying? You are buying a call option with $5, right? Absolutely. Which means that as long as between 45 to 50, you will lose $5. If the price goes below 40 or above 55, you will start making money. And between 40 to 45 and 50 to 55, you will suffer a loss, but you will suffer a reduced loss. Right? So obviously, this means that if the price is below 40 or the price is above 55, you make a profit. Between 40 to 45 and 50 to 55, you make reduced losses. And between 45 to 50, you make a fixed loss of 5. So this is what will happen. Below 45, if ST is less than 45, how much is your profit? Your profit is 40 minus ST. If it is between 45 and 50, how much is your loss? Your loss is minus 5. Your loss is 5. And if it is above 50, it is actually ST minus 55. So the strict profits will happen when ST is below 40 and ST is above 45 or ST is above 45. In between, you will make reduced losses with the maximum loss being minus 5. So if I were to, so that is what happens, right? Now look at this. If you take a box spread is a combination of a bull call spread and a bear put spread at the same strike prices. What is a bull call spread? Remember, bull call spread is buying at a cheaper price, selling at a higher call, buying a call option at a cheaper price, selling a call option at a higher price. The bear is exactly the other way around. So what is the net payoff? How does the net payoff show up? This happens. So again, sorry, I don't know. And sometimes it happens, I don't know what happens. So if ST is greater than K2, how much will you earn? You will earn K2 minus K1, right? And at the far end, you will earn K2 minus K1. If it is between K1 and K2, how much will you earn? Remember from yesterday, you will earn ST minus K1. And if it is less than K1, you will earn nothing. Similarly, if it is a bear put spread, so the bear put where ST is greater than K2 on the put side, you will earn nothing. On the and for the other ones, you will earn K2 minus ST, K2 minus K1. You have both of them. You have sold both. You have bought both of them. If you add all of them up, you see that irrespective of what happens, the total premium, sorry, the total benefit under all scenarios is K2 minus K1. So you get a fixed amount of K2 minus K1 irrespective of what happens. Now, if there are no arbitrage opportunities, obviously you can't have arbitrage opportunities by design. Therefore, there will be no one assumes that there are no arbitrage opportunities, and therefore that makes it that basically makes the price of the box trade today to be the present value of the expected payoff. The expected payoff under all circumstances is K2 minus K1, and therefore the price today is going to be nothing but the present value of K2 minus K1. So this strategy is useful if the total setup and transaction cost is less than the present value of K2 minus K1, and you are kind of getting a fixed return irrespective of where the spot price goes. So this kind of gives you a fixed return model. Now you can ignore this, and for all practical purposes, you can ignore this because this is what is called the diagonal spread, or essentially a time spread, where a time spread where I am kind of playing around with the time strike, well, not with the strike prices, but with the time to maturity. And as I said earlier, we will not really worry too much about the price, the vertical or the time spreads, because that would kind of that could potentially lead to a complicated scenario, and that's why we don't want to kind of look at that in that sense. Finally, there's this one diagram that I have done. So, I've kind of drawn all the four. In each case, we are assuming that the strike exercise price is equal to the current strike price. So your S0 and K is the same. So how will the diagrams of each of them look like? So I have one share, one short position, two shares, one short position, one share, one short position in two call options, and one share, four short position in four call options. If I draw this is what happens. In the first case, what is it? One share, one short position in one call option. So you have the short position in the call option, you have one share in the long spread, and therefore the dark line is essentially the resultant position. The dark line kind of works out with the resultant position, which is essentially nothing but a short put. As you can see, when you move from 1 to 2 to 4, the slope of the line, the slope of the payoff structure kind of changes. So in the last, in case C and D, C is what? One share and one short position in two call options, and D is one share and short position, four call options. You effectively see that you are kind of getting a graph which is similar to a short straddle. The normal straddle is the V, you are getting kind of an inverted V, and therefore what you are landing up getting is essentially something close to a short straddle. So that could be, that is one way in which you can kind of value them. Now, this is all that I had to talk about out here. Before I move on, now the next thing is to look at all of this is fine. I assume that I know the price and therefore I can compute it. Now, I have before I move on to the pricing part of it. I just want to highlight one small thing with you all before I move on to the pricing argument. So we've done all of this. There are many more that can be done. These are the more common ones that I have shown you. And then, as I said, there can be like a lot more that you can kind of do. The question that one asks and the question that one looks at is, what is the utility of doing it? Because I'm sure a lot of you will be asking that, okay, fine, we've done all of this. Very good. We've created a bull spread, bear spread, butterfly, straddle, strip, strap, all of that, or whichever you want. Why have you done this? Because the key question that you will actually still need to answer is, why have you done this? What is the utility that you get by doing this? So that is one important question that you would need to answer as to why and what is the benefit of doing this. As you saw, the benefit of doing this is that if you have a certain view of the market, if you have a market condition, if you have a market view that you want to play with, you can then create a structure to protect yourself against against the issues that can come up because of the position that you have taken. So, or because of the underlying asset that you have. So what you are effectively saying is that for the normal risky positions that you have, you can right. So what you can see is that you can then kind of replicate your market view with through the structures, and you can reduce your risk as well as reduce the relative cost. Now I know you can argue that in a straddle or a strangle, how are you reducing your cost? It can actually, you are adding both, but realize you're also reducing the risk significantly. So obviously, the if you reduce the risk, that is the cost you are paying for reducing the risk, and that is how it will kind of work in that fashion. So you're actually having a reduced risk, and because there is a reduced risk, you will actually have to pay a higher cost. And how does it adjust up? Because remember, even if you make a profit, your cost is high, so your net premium, or sorry, net income, or your return is low, and which is the same case that obviously if your risk is low, your return is also low. By buying both the options, you have reduced your risk, and therefore you have also reduced your possible income. For those who take a larger risk, the return is also much higher, right? Okay, any questions? Any questions on this? Do you have any questions? Otherwise, we'll move on to this option pricing. Okay, then let's move on to option pricing. Now, there are two ways in which you can price the option. There are two ways in which you can price the option. One is, as I have it out here, what is called as the binomial option pricing model. This is what is referred to as the binomial tree-based option pricing model, or the binomial option pricing model. The other is what is called as the approach using Black and Scholes. So Fisher Black and Myron Scholes came up with that, which has become extremely popular around the world, including it has been added. I mean, the name of so the alternate approach, what is Black-Scholes, is also sometimes the name of Merton is also added onto it, and it's also referred to as the Black-Scholes-Merton model. Obviously, that becomes the most popular model, and Myron Scholes and Bob Merton did even get the Nobel Prize for that, for figuring that out and applying that in practice. Obviously, Fisher Black was also there, but by the time the Nobel Committee got around to offering Nobel Prizes, Fisher Black had passed away. And under the condition, nobody who is no longer there, who's no longer physically present, who's no longer physically alive, can be granted the Nobel Prize. And hence, Fisher Black never got the Nobel Prize, but Myron Scholes and Robert Merton, got the Nobel Prize for that. But before we go there, I want to kind of show you the binomial option pricing model, and then we will talk about the Black-Scholes afterwards. So the binomial tree option pricing model is fundamentally based on this logic, that it is based on the primary logic that the binomial option pricing model is based on is, from a given point, prices can move in two directions. Prices can go up or prices can go down. The assumption is that prices cannot remain constant. So the assumption that they have is that prices will not remain constant. There is no possibility of the price remaining constant. And that is what the whole assumption in this structure is. So prices will not remain constant over a period of time. Now, what this means is that, I mean, what this implies in a sense is that except for interest rate as an underlying. If you have interest rate as an underlying, then it's a different story. But if you do not take interest rate as an underlying, the binomial tree will hold good for pretty much all other underlying asset classes that you have, except for interest rate, because in the interest rate is underlying asset class, interest rate does not need to change. Interest rate does not need to change across time. Interest rates can remain constant across time, and hence, instead of instead of two possible branchings, you can end up having three possible branchings in that scenario, in which case it is called a trinomial tree. But for at this point, it is for equity and all other asset classes, we take it to be that there can only be two branchings, and we take it to be the binomial tree. Well, there are not two branches, but what it can be multiple branches. We obviously look at the two extreme points to look at it, but effectively it is nothing but the the only assumption is that the probability that the asset price will remain constant is essentially zero. But we are not saying whether it will move up or move down, and that is what we want to show there. What is also assumed is that the stock price follows what is called as a random walk. What is a random walk? A random walk is basically a process where the current observation or the current position only helps me determine where I can go from here. The history of the past assumptions does not tell me where does not give me any indication of that. So the current value only tells me where I can move from here, whether I go up, go down, and whatever. Not how I have moved over the past period. The stock price is supposed to follow similar to that, a random walk, because tomorrow's stock price is dependent on what the stock price today is. Our assumption is that how the stock price moved over the last whatever number of days does not impact what the stock price will be tomorrow. What it does is, where it does impact or where it does come in is, given that the stock price is whatever it is, that is all that will be relevant in kind of determining the future stock price. We do not know whether the asset price will go up or go down, but what we assume is that at each step, the stock price there is a certain probability with which it can move up, or it can be a certain probability and therefore a certain probability with which it can move down. So if I know the probability of an up move, then the probability of the down move will have to be nothing but 1 minus the probability of up move. So if P is the probability of up move, then 1 minus P is essentially nothing but the probability of the down move. Now this last sentence, we'll leave it at this point. I will talk about it a little more when I talk about the Black-Scholes framework and the Black-Scholes assumption. At this stage, I do not need to make the last assumption, but what one can show is that if the steps become smaller and smaller, it will kind of move in that fashion. It will kind of move in a log normal fashion. So basically, and obviously, if you take the log normal distribution is a continuous distribution. So if you reduce the interval, essentially you're observing it at shorter intervals. Your discrete time distribution will also represent a continuous time distribution. So let me show you this example. So let's say the current stock is currently priced 20. At the end of 3 months, so let's start with the simple example. At the end of 3 months, the stock can either go up to 22 or go down to 18. So therefore, how much can the stock move by? As a proportion of the current price, how much does the stock move by? The current price is 20. I'm saying at the end of 3 months, it can move up to 22 or it can move down to 18. So how much can the stock price move by as a percentage of its current price? 10%. Because 10% of 20 is 2. So therefore, it can move up by 2 units, which is 10%, and take you to 22. Or it can move down by 2 units and take you down to 18. Okay? So if I were to draw it, I will put it in a diagrammatic form. This is what it will look like. Now, I do not know whether the price will go to 22 or not. But I'm saying if it can go, and it can go to 18 also. And the current price is 20. Plus, there's a 3-month thing. There is another thing that I should actually highlight first, which is irrespective of what happens. This is something we said earlier also. Irrespective of what happens, the price of the option is only going to be dependent on 5 terms, and those 5 terms I have to match it out here. But what are those 5 terms? Spot, strike, interest rate, time to maturity, and volatility. Now, what are the three? How do they match up? The current spot is 20, which is given, so therefore that matches up. The time period is at the end of 3 months, therefore the time period is 3 months. Right? So I know spot, I know time period. What I also know is at the end of the time period, how much will the prices move to? And therefore, I can find out that from the current level, it will move up to whatever it is. So therefore, and you're saying to move, and it can move up to 22. If the current value is 20, and you say it can move up to 22, or it can go down to 18, therefore the movement is essentially only 10%, or sigma is effectively 10%. Right? So as spot, I have volatility, I have time. These are the three things that I know now. I'm now defining this to be an European call. Why do I need to define it as a call? Define this? Because depending on whether it's a call or a put, the payoff structure will be defined. Remember, for a call, the payoff structure is maximum of ST minus K and 0, whereas for the put, it is max of K minus ST and 0. Right? So now, if the price is 21, what happens if the asset price goes to 22? Your call option gives you the right to buy the asset at 21. So how much of a benefit do you make? So the market price is 22. Your call option, your option gives you an opportunity to buy it at 21. So how much of a benefit do you make? 1, right? And that is what shows up as the option payoff. Similarly, when the price goes to 18, will you buy it at 21? The answer is no, and you will buy it in the market. So therefore, your option payoff goes to 0. Right? So when the price goes to 22, you will buy the option at you will pay 21 and buy the option. Sorry, you will exercise the option, and option is in the money, and therefore, and how much profit do you make when the option is in the money in this case? 1. In the context of when the price goes to 18, the option is out of the money, which means you will never exercise it, and therefore, how much will you earn, or what will be the payoff? The payoff will be 0. What I need to find out is what is the option price today. Now, there are different ways of doing this. One way of there are two, but when they're the same, there are different approaches to doing this. They're essentially the same thing. So what we want to do is we want to set up a risk-based portfolio, right? Of the stock and the option to eliminate the uncertainty. So what you do is, let me go and buy some shares. Let me go and buy delta shares, D or delta number of shares, and short 1 call option. So I've bought some shares, I've shorted 1 call option. Now, when the asset price goes to 22, how much is the value of the shares? The value of the shares will then be, remember, I bought delta shares, so the value of the shares will be 22 delta. Because it has gone to 22, I am losing 1, and I shorted the call option. I will lose one. I will lose 1 because the cost of the option, the benefit from the option in the event the price goes to 22 is 1. So I therefore lose 1, and therefore the value of the portfolio becomes 22 delta minus 1. When it goes to 18, what happens? I still have delta shares, so my so that is worth 18 delta, but the option payoff is 0, so essentially it's 18 delta. I now want this portfolio to be riskless. What do I mean by being riskless? What I mean is I don't care whether the price goes up or the price goes down. Irrespective of where the price goes, I want the value of this portfolio to be the same. So even if it goes up or it goes down, I want the portfolio value to be the same, which essentially means that I will therefore have to say, I will have to equate the process. 22 delta minus 1 will be equal to 16 delta. Sorry, 18 delta, not 16, 18 delta. And then when I solve for it, your delta or D essentially works out to be 0.25. Right? Which means that you should buy, theoretically, what it implies is you buy the option with So I have to have put my 22 delta, sorry, 22 delta minus 1 is equal to 18 delta. If you solve for it, your delta or D is essentially 0.25. Now, if I have the share price 0.25 shares, so what is the value of the portfolio? 22 into 0.25 minus 1 or 18 into 0.25, and therefore in both scenarios, you see you get the value of the portfolio to be 4.5. Now, what you are saying is the portfolio is worth 4.5 in 3 months' time. This is 3 months. How much is the value of the portfolio today? You therefore discounted, you need the interest rate. I've given the interest rate out there with 12%. So the present value of 4.5 over 3 months at 12%, that works out to be 4.3670. So the value of the portfolio today is theoretically, the value of the portfolio today is 4.3670. So therefore, I kind of calculate the present value of that, and the present value of that works out to be 4.367, which is nothing but discounted at 12%. So now what do I have? I have the current portfolio, which is delta shares, and one short option. And what is the value of the portfolio from that side? The value of the portfolio is the current price of the shares is 20. I have delta long shares, delta is 0.25. So the share part of the portfolio is worth 20 into 0.25, which is 5. I've shorted one call option. So this is the value of the portfolio. So 5 minus the value of the call option is what is my portfolio value. But on the other side, I've also got the portfolio value to be 4.367. So now if I equate this to, I will get the value of the option to be 0.633. In other words, I'm saying that somebody would be ready to pay 0.633 to buy an option, to buy the right to buy the asset at a future point at a price of 21, with the current price being 20 and the volatility being 10% and all that. If the price goes up, if the upside volatility matures, if the price goes up, then you are going to make, then the holder is going to make $1. If it goes down, the holder is going to lose everything. Right? So therefore, on an average, he is ready to pay for every dollar benefit, he is ready to pay 0.633 in that sense. Now, I could also do, but this is correct. This is a theoretically correct way of doing it, but there is another way of doing it, which is probably a little easier way of doing it. And there I'm going to calculate the probability. So what I'm saying is my current price is S0. From S0, I can move up. So my current price is, okay, if you look at that, my current price is S0. P is the maturity time of the option. From S0, I can move up to an up level, which I'm calling it S0U, or I can move down to S0D. And FU and FD are the payoffs from the option when it has gone to SU or S0U or S0D, right? And F is the option price today. So therefore, if I plotted this, this is how it will look like. It can go to S0U, it can go to S0D, and now I'm adding a probability statement, which is the same as in the previous case, except that there we were calculating the riskless portfolio. Here I'm going to calculate the riskless probability and play with the probability. Right? So I'm saying it can move up with the probability P, it can move down with the probability of 1 minus P. And the natural understanding is P and 1 minus P are the probabilities of up and down movement. So as you can see, if you go up, you move with the probability P. If you go down, you move with the probability of 1 minus P. Now, how did I get what? Now, the price of the option is given in that. What is that bold statement out there? P into FU plus 1 minus P into FD e to the power of minus RT is what my price of the option is. Now, how do I calculate this? Because you see, how do I get the P? How do I kind of get the P? And then once I get the P, then I can, how do I get FU and FD? Well, FU and FD are simple because it is basically maximum of, it's a call option, so maximum of S naught U minus KX and 0 in both cases. So therefore, I can calculate the F naught U and the F naught D. Sorry, FU and FD. How do I calculate the P? Well, to calculate the P, I do one thing. I'm telling you, on one hand, you can reach a price of S naught U with a probability of P, and the price of S naught D with a probability of 1 minus P. Right? Therefore, what is the average price in that case? So you can get, so basically you can get to, so let me write this down because it is not here. You can get to S naught U with probability P and S naught D with probability 1 minus P. Okay. What is the expected value at T? So what is, I've written it out there, I've typed it for you all, it will be easier for you all. What is the expected value at time T? You can get to S naught U with a probability of P. You can get to S naught D with a probability of 1 minus P. And therefore, what should be the value at, what should be the expected value? Or what should be your expected value at time T? So I'm saying you can move up to a certain level with a probability of P. You can move down to a certain level with a probability of 1 minus P. What is therefore the value of, what is the expected value, or on an average, what will be the value at time T? Basic statistics, what will be the expected value at time T? What do you think will be the expected value at time T? I've written that your probability to get to S naught U is P. Your probability to get to S naught D is 1 minus P. So what is the expected value in that sense? How will you calculate the expected value? Forget the table, forget the graph and all that. Simple question, how will you calculate the expected value in this scenario? What is the expected value at T? You all should be able to tell me this. What should be the expected value at T? This is basically basic statistics that you have done earlier. What do you think? Somebody? Come on, somebody? Somebody? What is the expected value at T? Now, this is something that you all have done as in basic statistics. So you should be able to tell me this. This is nothing great. How much will it be? How much will this be? Come on, somebody. You should also try to attempt it. How much will this be? Nobody. Nobody even wants to try. The expected value will be P times S naught U plus 1 minus P times S naught D. So P times S naught U plus 1 minus P times S naught D. This is what will be the expected value on maturity. That's on one side. The other side of the story is the current price is S naught. The interest rate is R. The time to maturity is T. Therefore, what shall be the future value of the asset? The current value is S naught. Time to maturity is T. The interest rate is R. What shall be the future value of the asset? If the current value is S naught, the time to maturity is T, and the interest rate is R, what should be the value of S naught? What should be the value of future value? I know the current value, which is S naught. I know the interest rate. I know the time. So what should be the future value? What should be the future value? Somebody? The current value is S naught. The interest rate is R. The time to maturity is T. What is the value in the at maturity? Well, none of you don't want. You all just want me to write it down, and nobody wants to even attempt it. Well, I mean, what can I do? The value is going to be S naught exponential of R and T. So S naught into X e to the power of RT. Both are the values of ST. So therefore, that means that S naught exponential RT is equal to P into S naught U plus 1 minus P into S naught D. So this equation is satisfied. If this equation is satisfied, then what happens? I know S naught, I know R, I know T, I know S, I know U, I know D. U is the rated amount it moves up, D is the amount it moves down by. So I know both of them. So using this equation, I can solve for P. There is only one, I'll show you a numerical number in the next slide, but there's only one equation I can solve for P. Once I solve for P, what happens? I can then go back and apply it on the F structure. So for the same story, F should be equal to Fp now P times Fu plus 1 minus P times Fd, the discounted value of that, which is essentially what the black line is. Right? Now, let me show it to you with numbers. Right? This is the same value as I had last time. Right? I should actually also I'll show it to you out here. So I have this, so this is 1 minus P and all of that I'm getting. There is the solution of P that was done here, which is not showing up. Now, if I solve this, what will be P? Realize I can cut out S naught on both sides. So what will I get? I will get exponential of R times T is equal to P into U plus 1 minus P into D. Because S naught is the same, so I've cancelled S naught from both sides. This is what happens. So now if I solve it, what will I get? You'll get P into U minus D. So you will get P is equal to EXP RT minus D divided by U minus D. Right? This is nothing but the solution to that previous equation, and this is what your P is. So now plug in the values. I know R is given to be 12%. You can read out there. T is 3 months or 0.25. So I can calculate it to the power of RT. I can calculate U is from 20, if it goes to 22, S naught U is therefore U is 1 point, U is therefore sigma or 1.1 going up, or at D is it goes down from 10, 20 to 18. So 20 is equal to 18 into D, therefore D is 0.9. So I know U, I know D. 1 minus U is 1.1, D is 0.9. So it's e to the power of RT minus 0.9 divided by 1.1 minus 0.9, which is 0.2. And then if you solve it, you'll end up getting the value of P. So if you solve this, you can look at from here. The value, in this case, P therefore was equal to 0.6523. 1 minus P equals 0.3477. Right? So I have these values of P and 1 minus P, and I've solved for it. So now once I have solved for it, I go back and plug the numbers in again in the other equation, and you realize that I solve for it, I get the same value of the option that I got earlier. So I kind of get to the same place. Now the question is, why did I do this? And that will become evident in the next slide. Why did I do this is what is kind of becoming evident in the next slide. So I've calculated the value of the option. This is Choro. Okay, this is just okay. So I will come to this. I will try to talk about this. This is something which I have done, which I wanted to show you also, and you don't have to. You can skip some of these slides. Now, why should the period just be one period? It could be multiple periods, and therefore I can take it to be more than one period. I can take it to be 2 periods, 3 periods, 4 periods, and so on and so forth. So I am taking this to be a 2-period tree. I've kept everything else to be the same as in the previous case, except one thing, that I now have 2 periods, so I can go from 20 to, my first period is from 20 to the first time point, which is 22 or 18, and then I go once again to the next period. One of the things I have done is I have kept my sigma constant. What is the value of sigma? Guys, what is the value of sigma in this? What is the value of sigma? What is the volatility that I have taken? Given this tree, what is the volatility that I have taken in the tree? Somebody. How much is the volatility that I have taken? In this tree, how much is the volatility that I have taken? What is the value of sigma? In this, how much is sigma? How much is volatility? We did this in the last thing. I used the whole example and I told you what sigma was. So what is the value of sigma in here? Guys, somebody please, what is the value of sigma? Please tell me. What is the value of sigma? What is the value of sigma? Are you all there? Are you guys there? How long does it take to calculate? It can't take that long. What is the value of sigma? Let's see. Okay, since you are calculating, I'll wait. Yes. How much is the value of sigma in this diagram, in this tree? So have you all calculated what is the value of sigma? What is the value of sigma? What is volatility out here? How much is the volatility? Hmm? Absolutely. You took this long, it's 10%, right? And I'm keeping this 10, you're right, it's 10%, but I'm surprised it took you this long to calculate. I am keeping this 10% constant. So what happens? From 20, when you go up 10%, you go to 22. You go down 10%, you go to 18, right? Now, when you go to 22, I'm again keeping my 10% constant. And then, therefore, if I'm at 20, if I'm at 10% from 20, if I go up, I go to 24.2. If I go down, I go down to 19.8. Similarly, when I went down to 18, if I now from 18, I can again go up or go down. If I go up 10%, I go to 19.8. And if I go down, I go down to 16.2. Now, two things. I will now have to define whether this is a European option or an American option. The reason why I have to define whether it's a European option or an American option is because in an European option, there will be no possibility of exercise in the middle points. So when the price goes to 22 or 18, I cannot even think whether a possible exercise can happen. And I will actually have to live with it. My payoffs will only happen at time point 2. So my payoffs can only happen when the asset price either reaches 24.2, 19.8 or 16.2. There can be no payoffs in the context when the price goes to 22 or 18. That is the logic of an European option. We will talk about an American option subsequently, because in an American option there is a small change that can happen, and that is what I want to show you also in that sense, right? So that cannot kind of happen in that process. Now, obviously, I have kept my sigma constant, and you realize my sigma is 10% across the board. Now, this is a controversial assumption. This is something which is not a very easy assumption, not something which is very, very practical. Because particularly if the period is long, your argument that the volatility will remain the same over a long period of time is highly questionable. And people can ask, why are you making this assumption? Well, I'll give you a rationale as to why we do that assumption, but there is two simple reasons as to why we do this assumption. And that is what I had kind of written out here. So let me go back and let me highlight that from here. Right. So if you look at this and look at this part, just look at this part, forget the top part. Just look at the bottom part. From every node, from every point, you can bifurcate into 2 points. From every point, you can go to 2 points. Therefore, if you now do it over n periods, if I replicate it over n periods, you will get 2 raised to the power of n nodes. Why? See, if you start off with 1, from 1 node you can go to 2, right? From 2 you can go to 4, from 4 you can go to 8, from 8 you can go to 16, from 16 you can go to 32, and so on, right? You start up at 1 node. From 1, how many can you go? You can go up or go down. So you can go to 2 nodes. Now, when you have gone up, again you can go up or go down. Therefore, you can go to 2. You go down, go up or go down 2. So 2 and 2, 4. 4 gets you 8. 8 gets you 16. 16 gets you 32, and so on. That is nothing but 2 raised to the power of n. So the number of nodes on maturity is essentially 2 raised to the power of n. And if I add the total number of nodes, that becomes 2 raised to the power of n plus 1 plus 1. So in this, how many? What is n? In this, what is n? What is n out here? In this? No, 2 raised to the power of 1. No. What is n? What is n? How many nodes are you having? This is 0, 1, 2, 3, 4, 5 nodes. So you get 2 raised to the power of 5, which is equal to, which we also know is equal to 32. So n equals 5, right? Therefore, if you take the next formula, which is 2 raised to the power of n plus 1, so what will happen? 2 raised to the power of n is 5, n plus 1 is 6, 2 raised to the power of 6 minus 1, which is equal to, how much is it? 63, 64 minus 1, which is equal to 63. Add this. If you add this, what will you get? 1 plus 2 plus 4 plus 8 plus 16 plus 32. This is equal to 48, 48 plus 8, 56, 60, 63. Right? So you see it matches. Right? Why am I doing this? Now let me show you the next slide. Now let me take this scenario. And this will happen when sigma is not a constant. So let me take a slightly longish period. Sigma is not a constant. Let me take n to be 12. If n is 12, 2 raised to the power of n is 2 raised to the power of 12, which works out to be 4096. And 2 raised to the power of 13 minus 1 works out to be 8191. So this is basically you are drawing a tree for 12 periods, and so it's like saying, I start off on the 1st of January, I will observe the potential prices on the 1st of every month, and I will do this for a year. So how many nodes will I have? On the 1st of December, at the end of 12 months, I will end up having possibly 4096 nodes, and if I add all the nodes in the tree, I will end up getting 8191 nodes. Now look at this. What happens if I take n to be 24, which is, I say I will look at the price on the 1st of January. I will look at the price on every month at the 1st of the month and the 15th of the month, which means basically my observations of 12 will now become 24. So my period becomes 15 days. The number 4096 increases to 16,777,216, and therefore the number 8191 increases to 33,554,431. So you realize that the increase is just phenomenal. The increase is just humongous. And it may not be very difficult to compute, but if that is the size of the tree, you will take an infinite amount of time to just try to resolve it. So it is extremely, extremely difficult. It is not difficult in terms of the difficulty level, but it is difficult from the perspective of time and resources that you would need to resolve it. And that is the problem. Now, if I take sigma to be constant, which is what I did, and what that will lead to is the fact that P and therefore 1 minus P will also be constant. When sigma is not constant, as I have it out there, P and 1 minus P and therefore 1 minus P are not constant. So for every period, I will actually have to recompute sigma P and 1 minus P. As we saw earlier, computing P is not a problem. But as I said, the amount of time that you take to compute P is so high that, the amount of time that you take to compute so many P's is so high, is that it will not really work in practice. On the other hand, as I said, if I take sigma to be constant, this implies P and therefore 1 minus P will also be a constant. So now, if that happens, interestingly, the 2 raised to the power of n number goes down to n plus 1, and the 2 raised to the power of n plus 1 minus 1 number becomes nothing but n plus 1 into n plus 2 by 2. So now let's compare them. When n is equal to 12, n plus 1 is 13, n plus 1 into n plus 2 by 2 is 13 into 14 by 2, which is 91. When n is 24, what happens? N plus 1 is 25, right? N plus 1 into n plus 2 is 25 into 26 by 2, which is 325. Yes, the numbers increase. The numbers are not constant, the numbers increase. But the rate at which the numbers increase is much, much smaller. Plus, I don't have to recompute P every time. In fact, once I compute P, that will hold good for the rest of it. So I save time on, say, calculating P. I also save time in terms of the size of the tree, and therefore I kind of get the benefit in that process that I have. So that is the advantage of this. Now, the assumption here is that I have taken the sigma to be constant, which is not shown about here, but in your slides you will have it. I have taken sigma to be constant. Now, can I take sigma to be constant? So the question that you need to ask is, can I take sigma to be constant? Well, the problem is, none of us know what the true value of sigma is. We are trying to estimate, at some level we will have to try to estimate the true value of sigma. Now, if none of us know what the true value of sigma is, therefore, whether I take a constant value or even if I take a changing value, I do not know whether I've got the correct value or not. So if I do not know whether I've got the correct value, I might as well take a value which will help me, or will have a simplified process and therefore help me work around that. And therefore, I take sigma to be constant. And then I kind of estimate based on that. At least I have a solution in real time which I can work on, and I can kind of compute based on that. So that makes life a little simpler for me, and hence I can kind of easily compute it as a function of that. That is what my assumption of sigma to be constant is. Now, what I've done out here, and you can ignore this, but these slides, what it shows is the point that, the previous slide shows that if I take sigma to be constant, then my P and then my 1 minus P will remain constant irrespective of where I start from. This slide shows the proof that if they are not constant, so if my sigma and sigma is different, then essentially I will not get the constant sigma, and hence my P and 1 minus P will also not be the same. They will also change. Now, as I said, this is the proof of that. I've done it out here, but you don't really need to kind of prove it. You can, it's so obvious that you can kind of take it and go and take it from there. Let's go back here. Our sigma is a constant. Therefore, the P that we calculated in the first phase will kind of hold, and we don't need to recompute P. So that is the advantage that we kind of get in this process. Once that is done, okay, now let's go to the next slide. What happens? So I need to calculate the value of the option. The objective is to calculate the value of the option. So now when the price goes to 24.2 and when the strike price is still the same as 21, how much will I benefit? If the price goes to 24.2 and the strike price is still 21, How much do I benefit? My benefit is 3.2 because I will be able to buy it at 21 when the market has gone to 24.2. So I will actually save I will actually benefit by 3.2. When the market goes to 19.8, I will not exercise it and therefore I will not have any benefit. And similarly, when it goes to 60, if I don't do it 19.8, when it goes to 16.2, the same story will hold. I will not do anything. Right? Now, how do I price it? And this is where the European nature becomes relevant. Right? What is the payoff at? So we've got the payoffs at D, E, or F. So if you reach D, E, or F, I have got you the payoffs, what the payoff values are. Right? Now, what I'm saying is, okay, let us look at to get to, if you were at B, if you were at point B and you move forward, where can you go? If you were at point B, if you are standing at point B and you move forward, where can you go? From B, where can you go? What are the possible points that you can go to if you were at B? So where do you, oh, no, not D, D, yes, and if you go up, you go to D. What about if you go down? If you are at B and you go up to D, right? But if you go down, where do you go down to? E, right? So you can go to B or E. So the value at B is going to be dependent on the value of at D and E. What is the value at D? The value at D is 3.2. What is the value at E? Payoff 0. So therefore, the value at the expected value is then going to be 3.2, the payoff at D into the probability. So you look at the figure, the value at node B is 3.2 into the probability, which is 0.6523, plus 0.3477 into the payoff at down there is 0. And then this you have to discount over that period. So you discounted at 12%, which was the interest rate for 3 months. And hence you will end up getting a value of 2.0257. Right? So that's how I get the value of 2.0257. How is the value at C 0? But again, the same logic. If you are at C, you can go up to E or you can go down to F. If you go up to, but in both cases, the payoffs are 0. Whatever the probability is, you are multiplying it by 0, and hence the value at C will always be 0. Once that happens, then I take, now thing is, I cannot, it's an European option, so I cannot exercise at B or C. I cannot exercise at 9.1. So there is no possibility of an exercise at 9.1. And therefore, I just apply the same logic once again. So 2.0257 into the probability, which is 0.6523, plus 0 into the probability, which is 0.3477, discounted by the same period, discounted by the interest rate and the time to mature and the time period, which is 3 months, you get the value at A. And therefore, you see the value at A that you work out once you solve these numbers is 1.2823. Well, if there was a value at E, no problem. What that would mean is that you would simply take that value and put it in that equation. And for C, there would be a similar equation that would show up. There is nothing else other than that will kind of happen in the process. Okay. Now let me show you an example, and this is still a put. This is still an European option, but this is a put option. So I take 52. Each time step or delta t is 1 year. So A is at time point 0. At B and C are potential values at time point 1. D, E, F are at time point 2. Now what is this? Now R is 5%. Given this tree, tell me what is the value of sigma? How much is the value of sigma in this tree? What is the value of sigma that I've taken in this tree? 20%? Absolutely. Good. Right? So now let's look at what happens. It's a put option. Right? So when does a put give you money? When does the put give you money? When the market price is higher than the strike price? Or, okay, the strike price is given to you to be 52. Does it give you money when the market price is greater than the strike price? Or when the market price is less than the strike price? So which one should happen? Market price greater than strike price or market price less than strike price? When will you get money in a put option? When will the put be in the money? When do you think the put will be in the money? Market price is greater than the strike price. Market price is less than the strike price. Which one? In a call option, you were getting money when the market price was more than the strike price. So therefore, in a put option, when do you get money? Market price greater than strike price, market price less than strike price. Yeah, in the money, but when is it in the money? You're right. You will get money when it's in the money, but when is it in the money? Price of underlying less than K, right? You are absolutely right. So therefore, in this case, at D, will you get a payoff? At D, so with your logic, at D, will you get a payoff? Is there a payoff at node D? Will you get anything at D? No. At D. How will you get it at D? What is the price of the underlying? At D, what is the price of the underlying? At node D, what is the price of the underlying? $72. Then how will you get a payoff? Because what is now look at this is what you wrote. Price of the underlying is less than K. Is this less than K? What is K? K is 52. 72 less than 52. So therefore now what should be the payoff at D? Is the put option in the money at D? Is the put option in the money at D? No. Therefore, there is no payoff. But at E and F, they are in the money. So there will be payoffs. So if I do this, forget this slide for a second, go here. Now you see the red lines. Here there is no payoff. Here there is a payoff. And here there is a payoff. Right? So now what I need to do is, okay, let me go back to one slide. So I know FUU is 0. FUD is, when I go up 2 steps, the value of the payoff at the option is 0. When I go up 1 step and come down 1 step, it is 4. And when I go down 2 steps, it's 20. You know your sigma is 20%. Therefore, U, which is the up move, is 1 plus sigma, which is 1.2. And D, which is down move, which is 1 minus sigma, is 0.8. So I can calculate the P. And therefore, I mean, the same formula that I had earlier. Here I had the formula. Let me show you, where did I write it down here? You see, this is the formula that I'm using. e to the power of r t minus d divided by u minus d, and you solve it, you get this value, and therefore you get 1 minus d as well, 1 minus p as well. Okay. Now this solution that I have written out here is correct, but I would suggest don't use this. Because what I've done out here is I've done the algebraic simplification and I've combined all of them together and I've solved for it in one go. This is correct. But if you do, but this might be a little difficult to follow. The easier way to do it is what I've done out here. So how do I get this 1.4147? So now what is the P? Remember, I got the P to be 0.6282. So therefore, what is 1 minus P? Right? Now, let's go here. So the value at B will be what is P? 0.6282 into what is the payoff at D? 0 plus what is 1 minus P? I've just calculated into how much is the payoff? 4. Right? Into EXP minus R is 5%, 0.5 into T is 1. No, that no, but you also have to discount, right? Because that is not the that's the value, the expected value at time point 1. So the value at B is the discounted value of that. So the exponential. So part of it, what you written is correct, but then you have to have the e to the power of minus RT, right? That is what you also need to write down. Similarly, what will be the value at C? Now this can be solved, and once you solve this, you get the number of 1.4147. What will be the value at C? Right? And when you solve this, you'll end up getting the value of 9.4636. Okay? Once you get these values, then you calculate the value at A. So by the same logic, the value at A will be. So now I know these values. So this value is 1.4147 and this value is 9.4636, and you solve it, you get the value to be 4.1923. So essentially the value of the European put option. So a couple of things. Okay, first, the value of the European put option in this case is 4.1923. Now remember one thing, whether you calculate the put option or the call option, the tree does not change. The tree and the probabilities does not change. What changes is only the payoffs at the nodes. The payoffs become changes from MAP in the call option case. So for a call option, So that's all that changes. Only thing that changes is, as you can see in the chat, the call option payoff is max of ST minus X and 0, whereas in the case of the put option, it is X minus ST and 0. There is nothing else that changes. The rest, once you get the payoffs, the rest of the computation is exactly in the same way as we computed for the call option or for the put option. There is really no change. Okay. Now, the last bit in this is if it became an American option, what would happen? If this tree, now if instead of calling it making it or calling it a European option, if it was an American option, what would happen? Well, everything would be the same, except at every node, I need to compute this. The benefit of holding on or the benefit from immediate exercise or early exercise. So if you look at this point now, the benefit of holding on, this 1.4147 comes from this expression, 0 into 0.6282 plus 4 into 0.3718 discounted, and that is how I get this value. Right? Now the market price, your underlying price is 60, your strike price is 52, and it's a put option. So therefore, as you rightly said, your underlying is more than the put option, the price of the underlying is more than the strike price. Hence, there is really no payoff. So therefore, the benefit from immediate exercise or early exercise is 0. You take the higher of the two, maximum of the two. What happens out here? The 9.4636 is coming from the discounted value of the subsequent payoffs, or essentially expected, what we can call it as the expected benefit of holding on the asset. The 12 is basically coming from where? By immediate exercise, because now your strike price is 40, your spot price is your spot price is 40, price of the underlying is 40, the strike is 52, and therefore you will be able to exercise it, and you will get, it's a put option. So look at the payoff. Payoff is X or strike minus the spot. So 52 minus 40, which is 12. Obviously 12 is greater than 0, so the payoff is 12. So I'm going to take that node to have the maximum of this 2, and therefore I have 12 out there. And then when I calculate, so that value will take the value 12, and when I calculate that value for A, that value then becomes 5.0894. So if you look at it, the process is the same. And how do I get this 5.0894? The same way, it is 1.4147. So this one 1.4147 into 0.6282. And now instead of 0.3718 into 9.4636, I take the maximum of this, which is 12. And obviously, if I put this value to be 12, this increases. And hence, this number in the previous slide was 4.1923. But since I'm multiplying this by 12 and not 9.46, the amount increases from 4.19 to 5.08. This also shows that the price of the American option will necessarily be higher than the price of the corresponding European option. This has to happen, right? The price of the European option will always be cheaper than or equal to the price of the American option. And what you are doing is, at every node, you are computing whether there is a payoff, whether there is a payoff from the early exercise, whether there is a benefit from the early exercise, or there is no benefit from the early exercise, and you are taking the maximum of the two. Why are you doing this? You are doing this because you do not know what is the outcome or what will the option holder do. Remember, one of the things that we said right up front is the choice is with the option holder and not with the option writer. The option holder can exercise if the option holder thinks it is profitable. Once the option holder exercises, the option writer has to deliver irrespective of what happens. So the option holder does not have the choice of not delivering. The option writer does not have the choice of not delivering. if the option holder exercises. And therefore, the option holder will not know, so the option writer will never know what the option holder will do. And the premium is the only income for the option writer, because otherwise the option writer will, if the option holder exercises, the option writer can suffer a loss. So therefore, to protect and prevent himself or herself, the option writer will take the worst case scenario that can happen, which is the option will be exercised. And that is when the payoff from the exercise value of the option is taken to kind of compute that value, which is then going to be the payoff from the option at that point. And then the rest of it will kind of work in that same manner. There is really no problem in that story. So that the only difference between an European and an American option, everything else is the same, is that at every node you will compute the expected benefit of holding on, which is the value if it was an European option. You will compute the benefit that you can get from immediate exercise, compare the two and take the maximum of the two to kind of solve the problem, to kind of take the value in that process. Okay. Okay, let me, obviously I can use this to kind of take care of other assets. So if you have a stock which pays dividend, what do? If you have a stock which pays dividend, no problem. Instead of generating the tree from S0, subtract the present value of the dividend from the tree, from the spot price. So if there was a dividend, take out this dividend from 50, present value of the dividend, and then draw the tree. So instead of drawing the tree at 50, maybe after you take out the dividend, it will become 48. Present value of the dividend, let's say it becomes 48. So the tree starts at 48. Because the advantage then is the non-recombining nature, recombining nature, even with the constant sigma and constant p will be maintained, and therefore you will actually have the life being simple. Plus, remember the whole argument that we used earlier, that if the dividend is paid during the life of the option holder has no chance of getting the dividend, and therefore the price has to be adjusted accordingly. If the dividend is paid after the life of the option, or after the option expires, there is no problem. The dividend can be paid. There is no adjustment that is needed. So the adjustment is needed only if the dividend is paid before the life of the option. Okay, now this is not showing up, but in your slide you will see that I have given you, again, this is some, I don't know why one slide shows and the other slide doesn't show up in Canvas. Now this is a slide in your, this is the slide that you will have in your deck, where what I've done is I've done a generic thing and I've put an A, and I have kind of shown you that if you take different asset categories, if you have different categories of assets, to calculate the P, what will be the value of A? So in some case, A is e to the power of minus RT, e to the power of RT, and obviously if you take a futures contract as an underlying, A becomes equal to 1. So once I know what the futures, what the underlying is, I can then plug in the value of A appropriately and calculate the value of the option price, the probability. And once I know the probability, I can kind of find out what the option price is. So this slide is only to help you out. I know on screen at this point, it is looking like blank, but in practice, you will actually be able to calculate this, because this will then show you what is the value of the option, what is the value of the probability, which you need to calculate the value of the option per se. Okay. Okay, let's do one thing. I think I've gone on for a bit too long. Let's take a 15-minute break. So it's about, what is it? It is about 9:20 for you, right? So it's about 9:20 in the evening for you. We will take a 15-minute. We'll start about 9:35, and I'll not do anything new today. I will just show you a few examples of this tree-based, binomial tree-based approach, so that tomorrow I can show you the Black-Scholes and I can move on from there very quickly. So I will kind of just show you some examples today, and we will wind up with that. But let's take a quick break, and we'll start in 15 minutes, which is 35 minutes of past 9 o'clock for you. And then in about that 20-25, half an hour, I will just show you the solutions, and I'll show you some of these examples and explain them, and we will close off with that today. Is it fine? Can we take a break? Okay, I'll just Pause the recording. It's okay in the last bit. The last part I forgot to record, but anyway, most of you guys are here. So let me stop with that. Any questions? Any questions anybody has? Okay, so my recommendation is that please do have a look at it. So if you have any questions, we can kind of discuss that tomorrow, and then take it from there. Okay. Is it fine? So can we then log off for today? Okay. Good night, guys. I'll see you tomorrow.